How's everybody doing? Welcome back to another episode of The Banker Next Door. I am your host, Dr. Joe Bergquist. This is the Lords of Easy Money series, and I cannot believe we've actually reached the final episode in the series, episode number 21. So I did the full recap of the book if anybody missed the last few episodes. So basically, episode 19, I covered the last chapter of the book, and then episode 20 was just a recap of the third part of the book, which was the last four chapters. So if you want to go back through and see the entire book, basically go, I break down each chapter, literally episode by episode. We go through each chapter. If you want kind of the shorter review version of the book, the quicker review, if you will, go to episodes 8, which is a review of part 1, episode 15, which is a review of part 2, and then episode 20, which is a review of part 3. So instead of sitting through the kind of 40 to an hour long episodes of the chapter reviews, if you want to get the quicker kind of gist or rollover, go see those 3 episodes in about an hour and a half. You can get the gist of basically the whole book. So and I designed it that way to try to give people a kind of a quicker option if you wanted to go through it. So, but what I'm hoping to do in this last episode here, which I hope everyone will find a little fun. So now that we've had a chance to go through the entire book and we've kind of seen what the Fed has done over the last 15 years, now we're going to look at some charts, and we're going to basically ask some questions here, like, so what was said in the book, did that really come through? Did the Fed really pump up the top 1%? Did they really have massive asset inflation? What did how did ZERP and the quantitative easing and the debt binge, how did that work out? We're going to take a look at a bunch of charts here that I'm hoping that people will find very interesting here. So let's get in here. I'm going to bring this in. So the very first chart that we're looking at here, and a lot of these charts we're going to look at are actually from the St. Louis Fred database. And so this chart is the net worth held by the top 1%. And basically we're looking at a chart this is from 1990 up until basically today, looking in 2023, 2024 right here. So what I want everybody to kind of take away here is that you can see here, basically here we get to 08 and we get to the financial crisis right in here. Going back a little bit, the gray charts basically represent, the gray bars on the chart represent recessions. So we get to the recession here, 07, 09. You can see it kind of bottoms out here in 09. But then after the Fed kicks in with ZERP and quantitative easing, what happens? Boom! It takes off. And then in 2020, when we have the pandemic, it takes off like a rocket into outer space. And then this was an article that I had actually covered in an earlier episode. I think I might have even covered it in episode 8 when I did the review of section 1. But this was an article from CNBC where it says, the wealth of the top 1% just hit a record $44 trillion. All of the gains came from stock holdings thanks to a year-end rally and the Federal Reserve. Remember what they talked about in the book. When the market goes, they call it a boom. They don't call it asset inflation. They call it, CNBC and Bloomberg say, oh, it's a bull market and we're booming. It's not asset inflation that was created by the Fed and everything that the Fed did, which is exactly the point. And this is what the Fed did. The Fed bailed out the very rich. So if you're one of the top 1%, you love what the Fed has done. The Fed, you have never been richer. You've made more money in the last 15 years than you've ever seen in your entire life. And that's what this chart here is illustrating. Just how much money has gone into these guys. So let's see here. So what else does it say here? So the total net worth of the top 1% defined by the Fed is those with wealth over 11 million, increased by 2 trillion in just the fourth quarter of last year. All the gains came from their stock holdings. The value of corporate equities and mutual fund shares held by the top 1% surged to 19.7 trillion. With their real estate values went up slightly, the value of their privately held businesses declined, essentially canceling out all other gains outside of stock. The quarterly gain marked the latest addition to an unprecedented wealth boom that began in 2020 with the COVID-19 pandemic market surge. Since 2020, the wealth of the top 1% has increased by nearly $15 trillion, or 49%. Middle-class Americans have also seen a rising wealth tide, with the middle 50 to 90% of Americans seeing their wealth increase 50%. Of course, this highlights a vulnerability of the economy if the stock market were to falter. This isn't the most likely scenario, but it is a scenario given that stocks appear richly overvalued. The top 10% of Americans own 87% of individually held stock and mutual funds. The top 1% own half of all individually held stocks. So the top 1% basically own 50% of all the stocks, and the top 10% own 87% of all the stocks. The wealth of the middle class and the lower income Americans depend more on wages and home values than stocks. So this is what the Federal Reserve has created. This is what their actions. And like you said, remember back to the book, they did this on purpose. This was done on purpose. Who did they bail out, and who did they make rich at the end of the day? So let's move on. Let's take a look at some other stuff. Okay. So this is the federal debt right here. So this is the national debt for the country. You can see that, and we're basically, and I went back a long ways here to illustrate a very important point. So if you go back to 1970 and you get to the early 70s, what do you notice here? We've hardly got any debt. We got hundreds of 492 million in debt in 1974. A very interesting thing happened. What happened in 1971? There was a very important event that happened in 1971. We came off the gold standard. Nixon took us off the gold standard. And you can see over the last 50 years, we have had an absolute explosion in our national debt that, started to get a little bit bigger around 1990. And what's kind of funny is I can remember as a kid back in the 80s, I can remember, Ronald Reagan always getting hammered for the amount of spending that he was doing. And it's kind of ironic now because the spending that he was doing back in the 80s is a pittance compared to the insanity that we have today. But you can just see here, and then now we get into 08, 09, and you can just see the explosion of national debt just straight up. And then we get another explosion here after the pandemic, boom. And so the question becomes, when you look at this chart, is like, does this seem like it's sustainable to anyone? Does anybody think this is sustainable? And the answer is it is not. And I just want to point out a very important thing. People will say a lot, and I'm gonna do a whole episode on the gold standard and what happened. I want to talk about, there are three very key events that happened in the 20th century that you have to spend a lot of time studying and understanding. One was the creation of the Federal Reserve in 1913. The second thing was the Bretton Woods Agreement, which happened in 1944. And then you have to understand, basically there was a meeting at Camp David with Nixon where he decided to take us off the gold standard. There's a great book written about that called 3 Days at Camp David, which I'll go over. And then it was Nixon taking, the number three thing was Nixon taking us off the gold standard in 1971. Now, there are people still alive today that still remember us being on the gold standard. And they're very old. They're older generation at this point, probably people in their 70s, 80s, 90s. But they're still alive, and they do remember how it was, and it wasn't all that bad. And there were quirks to the gold standard, but here's the thing. Politicians hate the gold standard. The Federal Reserve hates the gold standard. Why? You have to ask yourself why. Why do they hate the gold standard? Well, the gold standard was handcuffs. It was handcuffs on politicians. Politicians could not spend whatever amount of money they wanted to whenever they wanted to spend it. The gold standard basically forced them to keep a balanced checkbook. It forced them, if they wanted to spend, they had to go out and raise taxes to spend that money. Of course, raising taxes is very unpopular. So that's the dirty deed that the Federal Reserve and the government entered into. The Federal Reserve allowed, and kicking out the gold standard and having the Federal Reserve allows the federal government to write checks for anything they want, whenever they want, for whatever amount that they want. Thus, you have the bailouts. People don't understand that. They don't think about that in when we went through the Great Depression, they're like, well, why didn't the Federal Reserve come in and bail everybody out? Well, part of it was they couldn't because of the gold standard. Like they could, there were things they absolutely could have done and should have done to help the economy more back then. But the other important thing was that they could only do so much because of the gold standard had them locked in. They couldn't spend money willy-nilly the way that they do now. Now that's an oversimplification of that whole scenario and timing, but it's just something that I wanted to point out. Like I want people to understand that like the gold standard had its quirks, it had its things that worked, its things that didn't work, but at the end of the day, I want people to understand like why politicians and people at the Federal Reserve, why they hate the gold standard, why they all sit there and you'll hear all the talk about, oh, that's a relic of a bygone age and that doesn't matter anymore or whatever. Just remember that politicians hate the gold standard because it handcuffs them. It handcuffs them. It doesn't, they can't do this. They can't do this. They can't spend money like it's going out of style. They can't spend us into bankruptcy. And so you got to understand that our forefathers and people before us, they understood this. They understood the danger in giving government a blank check. They understood that this is exactly what would happen if we gave the government a blank check, that this is what the politicians would do. They would spend the money, they would spend us into oblivion. And that was a big, major reason why we had the gold standard in the first place. It was a check on the government in terms of what the government's spending, what the government could do in terms of spending. And for anybody that thinks that we didn't have the money to, build amazing things or whatever, look at all the things. Look at the major cities at the turn of the 20th century. Look at how built up New York and Chicago and San Francisco were. These cities were amazing. Look at Detroit. These were amazing cities. We had some of the finest cities in the world back then, and we didn't have a fraction of the debt that we have now. And quite frankly, the cities back then were much nicer than what we have today. And if you don't believe me, go look at the pictures. Okay, now let's look at the federal funds rate. So I want to talk about this for a second. So again, showing a wide period of time here. So we go back, this chart runs from 1955 up until today. And what I want to point out here is like, you can see in 1980, we had where Volcker, we talked about early in the book, how Volcker basically decided, he had seen the mistakes that the Fed had made in the 1970s and that he was going to fight inflation. So he takes the federal funds rate all the way up to the peak of 22% in December of 1980. And then it comes, kind of comes down from there. And we kind of bounce around a little bit. We're actually still at December of 1986, where we're as high as 14.35%. But then coming over here, you see 2007, 2008, and then boom, it just drops like a rock. And now we're down to 0%. At basically where are we at here? December or February of 2009, we're effectively at 0%, where we would stay until basically December of 2015. And so this is ZIRP. This is ZIRP right here. This is zero interest rate policy right here. And so what I'm trying to illustrate to people. And then we have the pandemic, and then boom, we're right back down to zero. And then we're back at zero for a couple more years until 2022, until finally the Federal Reserve starts to raise rates. Now, why do I show this? I show this because I want to point out the total irregularity of this period. Like if you look back at this chart over, a 60, 70-year period of time, you see that for the most part over these years, the range of a normal range of rates is going to be somewhere between 5 and 10% for the federal funds rate. That's going to be your average rate is going to fall somewhere in that neighborhood. And we talked a lot about the book about taking what's called the risk-free rate out of the market. The Fed took the risk-free rate out of the market. They punished savers. They punished retirees. They punished pension fund holders. They punished anybody who was trying to be normal and save money. They beat them into the ground and basically said, no, you're going to go reach for yield. We're going to force you to put your money back into the stock market. Okay. And you're going to have to take on a lot more risk to get any kind of yield. And this went on for such a long period of time. And that's why I wanted to point this out, because you need a longer breadth of time to understand why this was so abnormal, why this was so out in left field. Okay, so and that's the federal funds rate. That's what I want to point out. Now, let's look at total assets here. So this is total assets of the Federal Reserve Bank. And again, I want to point out that coming into 2008, you can see the Fed had a balance sheet of 883 million. Relatively speaking, small balance sheet, not really a whole lot going on, pretty quiet. And then we get into obviously the financial crisis, and we see this major pump up. And then here's where we start to see quantitative easing. But first, before we got into the full quantitative easing, they had like Operation Twist, and then Operation, like the second Operation Twist, and then they did kind of QE1, QE2, and then QE3 was like infinite. QE3 was just going to run. And you can see how their balance sheet, it just explodes up to 2.1 trillion. And then we're rolling out here. Now we're up to 2.8, and now we're up to 4.4. And I think we hit a high of about 4.5 trillion about 2015. That was kind of our high, and then we just stay there. We just stay hovering around there until about 2018, when the Fed decides, oh, okay, we're going to start bringing this down now, and they start paying it down, and we get to a bottom of about 3.7 trillion. And when do we get there? September 9, basically September of 2018. And we talked about in the book what happened in September of 2018. Oh, this was also right about the time that the repo market started to go nuts, because the reserves had run out of the repo market. And why did the reserves run out of the repo market? Oh, well, because the Fed was doing this. They were reducing their balance sheet, so they were running off the reserves. And then the repo market jumped, and then that basically started the market to crash. And then we got into the what they talked about, the chain of failures. So the Fed was basically, what you have to understand here is that the Fed had this idea originally back in 2010 that they said, oh, well, we're gonna do quantitative easing, and we're gonna blow up our balance sheet, but then no problem. We ran up 4.5 trillion, but we're gonna run this all the way back down to 1 trillion, and we'll have this pretty much taken care of within a few years. And we talked about in the chapter, that classic presentation that was made to the Fed, how this was all going to go smooth, and their balance sheet was going to get paid down, and they were going to get restored down to $1 trillion and be back to normal in a couple years. And basically how nothing in that presentation came true. Nothing. It was all just wild, unsupported speculation, and just all the numbers proved to be a total joke. So we get down here, July of 20, and then the Fed, and like I said, the Fed has their answer. They got down to about 1.3 trillion in repos, in cash reserves. And that was the magic number when the market started to go haywire. And then what happened? Jeremy Powell comes out and basically totally reverses course and says, okay, we're going to stop the quantitative tightening, and basically the normalization process is completely dead. And then basically they go right back, boom, and then the balance sheet jumps right back up to about 4.2 trillion. And then look at this, and where are we at? We're at March 4th of 2020. So we went from we went a low of about a little over 3.7 trillion, boom, to right back up to about 4.2 trillion right here. And that was to save the repo market. And then obviously the pandemic hits, whatever, and we are off to the races. And then just look at this. And we talk about this in the book, the massive amount of printing. They printed more money in a couple of months, in 90 days. 90 days. We went from here. Look at this. We were at March and we're at June 10th. Boom. $3 trillion. They printed more money in 90 days than they would have if they had been around for 300 years of existence. I mean, it's mind-boggling. So now they balloon basically the balance sheet all the way up to 9 trillion. They come down here. We hit a small blip. We get it down to about 8.3, and then boom, back up to 8.7. And then they've been bringing it down, tightening. And now we're down to about 7.2 trillion. And of course, Jeremy Powell has said that they're going to start to slow that down, that quantitative tightening that they've been doing, the selling off of about 80 billion a month or something that they've been doing. But here's an interesting thing. As we've said here, they started doing this before, and they got to the magic number where the repo market hit the skids, and it was 1.3 trillion was the magic number. I want you to remember that, because now we're going to look at the repo market. So we get back to here, March 30th of 2021. And look at this. Boom. This thing just takes off. And now we have, at the peak, in December of 2022, we have $2.5 trillion in cash reserves in the repo market. And now you can see how the Fed just pump this in here. This is all QE, baby. This is all the Fed, all their bailout programs, everything, just pumping all that money into the market. So we get to 2.5 trillion. I remember that magic number. What did I say? The magic number back in 2018 was 1.3 trillion in cash reserves. Once that ran down, we had problems. Let's see, where are we at today with our repos? Oh man, this looks like this thing has been falling off a cliff. And now we are down to today, we sit at 417 billion in repo cash reserves. That seems awfully low, doesn't it? Doesn't it seem like the market should be having problems by this point? So that leads to an interesting question here. So I'm going to read you guys an article here. This is from April of 2022. So the Fed paying banks not to lend has cost 1.5 billion in 4 weeks. With the gargantuan federal spending during the COVID-19 pandemic, banks have amassed an unprecedented hoard of cash reserves, money deposited by their customers. Normally, such reserves would be a dead weight on the bank's balance sheet, not put to any productive use. Banks would thus try to lend against it and invest it, making it circulate in the economy. In 2008, however, Congress authorized the Fed to start paying interest on the reserves, making it worthwhile for the banks to leave the cash idle. The interest was initially tiny, settling on 0.25% annually, but every time the Fed raised rates, this rate would go up too. By 2019, the Fed was paying the banks 1.5 billion every 2 weeks. Yet, as the government kept piling up trillions in debt, the Fed kept printing more dollars and the reserves grew dramatically, from less than 1.7 trillion in early 2020 to over 4.2 trillion in September of 2021. Even at the minuscule interest rate of 0.15%, the Fed was already paying almost 250 million every 2 weeks. The reserves started to taper then, but largely because of another Fed trick called the overnight reverse repurchase agreement, or reverse repo. It means the Fed sells the Fed obligation it owns to banks one day only to buy them back at a slightly higher price the next day. The price difference only added up to a 0.05% annualized interest rate, but the banks still jumped on the opportunity as it allowed them to make an immediate profit with essentially no risk and very little work. By the end of September, the Fed was paying about $2 million a day in reverse repo interest. As the inflation kept going up in March, the Fed finally started to raise the rates in a bid to tighten the credit spigots. The rates targets elevated from 0.25% range to basically 0.25 to a half a percentage point. The move appears tiny, but the impact on the interest payments was dramatic. The interest rate on reserves more than doubled from 0.15% to 0.4%. The reverse repo rate jumped to 0.3%, multiplying by 6. In the 4 weeks since the rate hike, the Fed dished out nearly $1.2 billion in reserve interest and over $300 million in reverse repo interest. The Fed foreshadowed plans to let the rates go up about 2% by the end of the year. Depending on how high the bank's reserves will be by then, the Fed can end up paying $5 billion or perhaps $8 billion a month to the banks. The cost of paying interest on excess reserves is not really relevant to Fed officials because in a worst case scenario, they just send the bill to the U.S. Treasury. That's very interesting. The cost of paying interest on excess reserves is not really relevant to Fed officials because in a worst case scenario, they can just send the bill to the U.S. Treasury. So let's take a look. How are the Fed profits doing? Let's take a look here. Look at that bar all the way to the left. That looks mighty negative. That looks very negative. Looks like the Fed's losing a lot of money on those reverse repo contracts and the repo contracts. Looks like the Fed's paying out a lot of money to the banks and losing their butt. And worst off, this is the worst case scenario has hit, and they are passing that buck. What does it say right here? The cost of paying the interest on excess reserves is not really relevant to Fed officials because in the worst case scenario, they just send the bill to the U.S. Treasury, which is you and me, the taxpayers. And that's exactly what they've done. So another reason why these overnight repos are being run off by the Fed is because it's costing them a fortune to have it, which is causing them to have these losses, which is the worst case scenario, which they are sending over to the Treasury. But at the same time, as this repo market is getting low, liquidity in the market is getting low, and this inevitably is going to lead to severe problems. And the Fed knows this. They know this. So this asset reduction on the Fed's balance sheet here, when we go back to the Fed's balance sheet, this is not going to continue. And the bottom line here is that the Fed will never be able to get this balance sheet back down. I mean, they're sitting at $7.2 trillion today. Do you think they'll ever be able to get this back down to say like $1 trillion or below $1 trillion? No way. No way. Unless something dramatically happens or dramatically changes in their policy and the people who are running the Fed, that's never going to happen. And then let's finish this article here. So I think they are walking themselves into a corner, but they have been adept at wiggling out of such problems without much damage to themselves in the recent past. So far, the Fed has no issue paying the interest. They got an issue now, baby. Due to its massive portfolio, which includes $2.7 trillion in mortgage-backed securities, it has itself collected over $100 billion in interest last year, but that still ain't enough. Of course, the money isn't free. You could say that in a sense, U.S. taxpayers would be footing the bill for the extra interest paid to the banks by the Fed. Yes, you could, and you do, in fact, say that. All right, so let's see here. So, okay, now I want to wrap up with corporate debt. Let's check in on our corporate debt here. So again, looking over at a long period of time, we go from 1950 basically here up until today. And again, you can see just as with the national debt, we have a very similar chart And you can see here basically 2000, what happens here, 2008, quantitative easing kicks in, the ZIRP policy kicks in, the debt binge kicks in, and look at this explosion. Boom! We're off to the moon. $14 trillion corporate debt. Look at that. Off to the moon. Take off. Boom. That's what ZIRP and quantitative easing and everything has done. But you might notice a little tiny curl there at the top as we start to tick down just a tiny little bit. And let's see. So what is happening? What is happening here with our corporate people with the higher for longer interest rates? How are they faring? If you remember what Tom Honig said in the book, that basically corporations and the Fed, they had backed themselves into a corner. They had taken on way too much debt. And if interest rates had to go up, this whole thing was going to implode in on itself. Okay, so what do we have here? So I want to use this as a simple example. Red Lobster. Red Lobster, a national restaurant chain, Red Lobster Management LLC, and its related subsidiaries announced on Sunday that it was voluntarily filing for Chapter 11 bankruptcy relief in the United States Bankruptcy Court of the Middle District of Florida. Now, it says in here that basically that, Red Lobster was struggling, and because of, higher operating costs due to inflation, $20 minimum wage, yada, yada, yada. But that's not really what happened here. What happened here was the hedge fund that bought Red Lobster loaded them up with debt. And then basically that debt was then, wait for it, what was the key term we used in the book? They had to roll the debt. They had to roll the debt over. Were finally forced to roll it over at a higher interest rate. And guess what happened? They couldn't pay the bill and they went bankrupt. And so it was the hedge fund, and exactly what happened here. Just like the example of Rexnord in the book, this is exactly what happened to Red Lobster. Exactly what happened. Let's take a look here now. One last article I have here for you guys here. Well, not second to last. Private equity portfolio company bankruptcies maintain record pace. And this is an article from S&P Global Market Intelligence. Bankruptcy filings by U.S.-based private equity portfolio companies are on track to nearly equal the record set in 2023 as inflation and higher for longer interest rates continue to take their toll. 34 U.S. companies with private equity or venture capital backing filed for bankruptcy between January 1st and April 30th, a 36% increase over the same 4-month period in 2023. Based on that sample, U.S. portfolio company bankruptcies are on pace to reach an annual total near the record high 103 bankruptcies registered in 2023. The combination of sticky inflation and higher for longer interest rates was enough to put some portfolio companies on the ropes, especially those already reeling from COVID-era business disruptions. It not only has affected borrowing costs, which has created a barrier to refinancing existing debt. Oh, there it is. They can't roll the debt. It also presents headwinds for revenue generation for businesses that have exposure to consumers. Private equity portfolio companies accounted for 16% of all U.S. bankruptcy filings in the first 4 months of 2024. They also accounted for 16% of U.S. bankruptcy filings in 2023, which was their largest share of the annual total going back to at least 2010. On average, between 2010 and 2023, private equity portfolio companies accounted for less than 9% of U.S. bankruptcy filings. The healthcare sector racked up the most bankruptcies of private equity portfolio companies between January 1st and April 30th with 12 filings, followed by consumer discretionary with 6 filings. I'm going to get into the healthcare industry in another episode, which the healthcare industry is an absolute mess. And I think we need to be very concerned about massive bankruptcies in the healthcare industry. But right there, those two examples are exactly what's coming down the pike. I mean, right now, banks have been doing what's called extend and pretend, trying to buy time. And that started last year in 2023. So you have the extend and pretend going on, which is trying to buy these companies time, because as they have to roll the debt, They're all going to end up like Red Lobster, Rock Lobster, Red Lobster. They're not going to be able to roll this debt, and they're going to go bankrupt. And this is then, and you're already beginning to see that the cracks are already coming in here. Finally, has the Fed, we talked about the 1%, if we go back here, we talked about the net worth held by the top 1% here in this chart, and we've seen how it's absolutely skyrocketed. And so ask yourself this question: has the Fed created asset inflation? We know that there's price inflation. Remember the two types of inflation. You have price inflation, you have asset inflation. So the Dow closed above 40,000. Here's how long it took to get there. The Dow Jones Industrial Average topped the 40,000 point level at Friday's close for the first time in history. Originating way back in 1896 and often considered a barometer of the overall U.S. economy, the index tracks the performance of 30 blue chip companies. The last major milestone for the Dow occurred in November of 2020 when the index closed above 30,000. The Dow Jones Industrial Average closed above 40,000 points on Friday for the first time in its 128-year history of tracking some of the largest companies traded on the U.S. stock markets. So what they're saying there is it took basically less than 4 years for the Dow to jump 10,000 points. And if you look at, I could bring up another chart here, but what I'm trying to point out to you is this is what the Fed has done. They have created, they bailed out all the banks. They have created the largest wealth inequality that this country has ever seen, any country in the world has ever seen, with the top 1% basically having $44 trillion in net worth. The top 1% has more net worth than the bottom 50% of the country. Like, that's a massive, massive problem, and I have never been one to say that we need to tax the rich, but I think we have gotten to the point where a lot of these billionaires need to be taxed. We need to do something to level the playing field here. And I think that if you're a billionaire that's got 10, 20, 30, 50, 60 billion dollars, it might be time for you to basically face a massive tax, and we might be time to strip some of that wealth away from you and return that back to the people. Now, how does that work? How do you do that? I'm not really sure. I'm just trying to give people a feeling for just kind of how I feel about it right now. So, but what do we have here at the end of the day? So let's wrap it up with this. Let's do was Christopher Leonard right about what he said was happening in the book? Yes, I think 100%. And I think that all the charts that I just displayed to you show exactly what Christopher Leonard was talking about in the book. And I showed here exactly how the Fed, they perverted the market. They flipped the market on its head. I shouldn't say pervert is a wrong word. Distorted the market, created massive distortions in the market, flipped the market completely on its head for the last 15 years. And like you said, we never really recovered in a very real way from the 2008 financial crisis. And it's the long crash, and it's just been going on and on and on. And every time something happens, it's just another bailout, and it's just more debt, more spending, more debt, more spending. And the problem is that can't go on forever. And where we're heading right now is to an even larger crash, a monumental crash, because what the Fed has created is the all bubble economy. Everything around you, you look at it, credit card debt, auto loan debt, student loan debt, housing debt, everything is a massive bubble, everything. And so the question becomes, when does that bubble burst? When does that bubble burst? And how does history ultimately look back on this period? I gave my thoughts in a couple episodes ago where I think that, the legacies of Ben Bernanke, Janet Yellen, and Jeremy Powell as heads of the Federal Reserve, that all three of them were bosom buddies. All three of them basically backed each other up. They all followed the same policies, the same protocols. They've all taken us down this path over the last 15 years. And so I think that their legacies are all interconnected. They're all intertwined together. And like I said, I do believe, it is my opinion, that when we get 10, 15, 20, 30 years down the road, people are going to look back on this period. I think that we're going to go through some rough times before we get back to better times to put this back to where it needs to be, so to speak. And that's going to cause major problems in the short run whenever that does happen. And I think that there is a chance that the Federal Reserve, and again, I'm not one of these people. I'm not necessarily saying like end the Fed, arrest these people, go do this, whatever. Like, no. I'm not saying any of that. What I do think though, is I think there should be a massive investigation. I think there should be a massive audit of the Federal Reserve. I think there should be congressional hearings. I think that even Alan Greenspan, very old man at this point, I think all of these Federal Reserve chairmen should be dragged up onto Capitol Hill, and I think they should have to testify for an entire week, every single one of them, every day, 5 days strong, 8 hours a day, hit them, boom, boom, boom. Why did you do this? Why did you do that? Why did you think that putting on ZERP for all these years was necessary? Why did you think that we needed all the quantitative easing? Why did you do, why did you allow the hedge funds to Jeremy Powell, why did you allow the hedge funds to totally manipulate and take over the repo market? What are you doing right now with the repo market? What is, you guys are masking and hiding all these problems. And, what is going on now? You guys have put us into a box. You've put us in this horrible position. You told us all this nonsense about, inflation was going to be transitory, but that didn't play out that way. So, I just think that we need some accountability, and we need to, like, their feet needs to be held to the fire, so to speak. And like I said, and I think we have reached a time where we do need to start really thinking about the Federal Reserve, the role that it plays in our economy, the powers that it has, the things it's able to do. And I think we do need to maybe have a course correction where the Federal Reserve really needs to get reined in, and we need to return to a pre-2008 Federal Reserve where they are much more limited in the number of things that they are able to do. In terms of them not being able to manipulate the market. And we need to kind of, in other words, the Fed has become the center of the universe, and we need to take them out of being the center of the universe. So, but that's, I don't know, that's just kind of my ramblings, my thoughts on this at the moment. But I want to thank everybody at this point for taking this journey with me. I want to thank everybody. I've had a number of people that have reached out to me that have said that they have loved the series. They've really enjoyed following it. I've had a few people that actually went out, bought the book, read it, really enjoyed it. I felt that this was one of the most amazing books that I had read in the last 10 years, and that it deserved this very deep, methodical introspection. And so I really do hope that people have enjoyed this series. I hope that people have learned a lot. I hope that this might garner you a better understanding of what's going on. And I hope you start to ask questions in the future as far as, if you see the economy booming, is it really a boom, or is it just asset price inflation? Is this really something good, or is this just more of the Federal Reserve manipulating the markets and making you think or have the appearance of being richer than you actually are? Is the Fed just doing this, to bail out banks and hedge funds and to increase the wealth of the top 1%? So these are just questions that I want people to ask. I want people to start pondering these things, and I want the Fed to have to answer some real questions on these things. That's it. That's all I ask for. Answer some real quick. Get asked some real questions, and have to answer those questions. That's it. It's just that simple. So with that, I will wrap up by saying thank you so much for just coming along with me on this journey. I really appreciate you hanging in there. And there will be more series, more different things like this to come. May not be books, might be maybe moments in history, maybe important financial events that took place, but there will definitely be more series like this where I will analyze, things on a very deep level like this was. And so like I said, I hope if you enjoyed this, please like, share, and subscribe. That will always help the series. It will always help the channel. I hope you will come back and check out some of the other content on the channel, some of the other things that I'm working on. And again, I just want to thank everybody so much, and I hope to see everybody again real soon. Thanks a lot.